Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to our first webinar this year, specifically for veterinarians. You know, some call this fall, some call it pumpkin spice season, but to us, this is vet webinar season. Today's is titled Navigating Business Tax Changes. Our next webinar is on November 18th, and that's where we'll be unveiling the results of our now fourth annual veterinary salary and benefit survey. So you'll definitely want to sign up for that. You can sign up for that at sva.com/vet series. So we have a lot of ground to cover today. So I just real quick want to touch on a couple things. You might remember back in 2017, we educated the marketplace on the Tax Cuts and Jobs Act after it passed. Fast forward a few years, in 2020, we were the leaders in making sure that you all were up to speed on PPP and ERC and everything else going on with COVID and how it was going to affect you. And of course, we do these educational webinars every fall. So now with the One Big Beautiful Bill Act passing, and we're calling it OBBBA for short, we're out in front again. Obviously, we have this webinar, but keep in mind, we are producing a lot of other content to help you. If you go to sva.com/OBBBA, so that's 3 B's, you'll see additional information like biz tips, past recorded webinars, lists of upcoming webinars that we have scheduled, and we do a weekly podcast called The Biz Beat by SVA, where we're spending about 15 to 20 minutes every week talking about different aspects of this bill, but then also other issues affecting business owners. As far as this webinar goes, please send in any questions you have as we go, but we're going to wait till the end to answer them. If your question doesn't end up getting answered, please reach out to me. I'll make sure one of our subject matter experts gets back to you. Also, if you'd like a copy of the slide deck, reach out to me and I'd be happy to send that to you as well. There's a lot of information on this slide deck, so you might end up wanting it. So really, without further ado, we've got 2 of our most experienced people in our healthcare and vet practice to walk you through everything today. We have Andy Slinger and Nate Drykosen, both of whom are principals who work with veterinary practice owners and practice managers on efficiency, tax, and profitability strategies. So it was kind of a long intro, Nate, but you ready to get this party started?
Thank you, Lee. Yes, I am. And
Great.
I will preface this that there is, you touched on it, there is a lot in this bill. And we're going to try and get through a whole lot of it today. Unfortunately, right, because of time constraints, there's going to be a fair bit of stuff that we don't get to. Among those is going to be some of the trust and estate provisions included in this. If you think that that might be impacting you and your future plans, you should definitely be talking with the appropriate advisor on that topic. But we are going to highlight very quickly some individual tax provisions because, as the title said, today is going to be focused on business, but ultimately some of this impacts you all as well. Some big key takeaways from the bill. For the most part, income tax rates are going to stay the same. Standardized deduction gets a little bit of a revision, but the whole idea that an elevated standard deduction from what existed previously is going to continue into the future. Looking forward to some of the credits, specifically those of you with children. Some of the structures of those are going to be remaining permanent and even getting slight bumps. Some additional considerations regarding residency that were built in. I mentioned that there is some tentacles with estate and gift tax. That tends to apply to very few people, so we're not going to spend much time on it today. Looking to the future, kind of a quick summary on many of these items. Generally speaking, we feel like this bill is going to have an overall net tax decrease for most taxpayers. It is important to familiarize yourselves and talk with your advisors about some of the individual tax provisions in this and how it might impact you, because both on the business and individual side, this is arguably the most sweeping tax legislation since the 1980s. Yes, the 1980s. So this will impact many, many people. Looking ahead a bit to some of the itemized deduction thoughts on what's in this bill, many of you are going to be impacted by this, namely with state and local taxes, mortgage interest deduction affirmed again, similar structure to what's existed the last 6-ish years or so. Many of these items were set to revert if they were not addressed. So in many ways, it's great that we now have some clarity and a game plan for how this is all going to behave going forward. Treatment of home equity debt, so home equity lines of credits or HELOCs, that treatment's going to continue and be made permanent. some changes to casualty losses for disaster areas, treatment of miscellaneous itemized deductions. Those are going to be permanently removed going forward. There are still some PEAS limitations or itemized deductions phase outs that were supposed to re-enter the arena here in 2026. However, those are being replaced with a different cap and different calculation. There's going to be some changes on charitable contributions, namely for those that do itemize. There's going to be a 0.5% base calculation to be aware of. So really the takeaway there is if you're looking at doing some bigger deductions or regular deductions and the decision is this year or next year, typically you're going to get more benefit from doing it before calendar year end 2025 than you would in 2026, typically speaking. So bring this around full circle, you're going to want to look at managing some income and potentially some state taxes to take advantage of some of the changes and some timing issues there, looking at front loading charitable gifts, and then looking to alternative ways to finance items that aren't related to home improvement as part of home equity debt. Andy, a few comments?
Thanks, Nate. I think as Nate alluded to, while this is very business focused, remember, I would say most of you are probably set up in an S Corp, right? And you're considered a flow through entity. So remember that all of your income from your S Corp flows through to your K1, flows to your individual tax return. So individual tax and business tax will always go hand in hand. Okay. So what we want to do then is look at just a couple of the new items, and I'll put a little bit of a business spin to them. So charitable contribution. Let me back up though. When we talk about charity, remember, when we consult with you, we advise you, when you can, do your charitable giving through the business, through your practice. It's a professional promotion. You're tying it to your business. You're promoting your business. You're growing your business and showing your charitable intent. So when you can, talk to your advisor about making sure that you are maximizing what's considered a professional promotion. For those items that truly fall under charity and you're reporting on your individual return, as you already know, most of the time, if you're taking the standard deduction and you're not itemizing, you're not really keeping track of your charity. But point here is starting next year, you are going to get, even if you take the standard deduction, you are going to be able to take either $1,000 or a $2,000 deduction for charity. So keep that in mind as well. Another one is vehicles. And this is more of a personal vehicle. We can have a long conversation about the best practice for business vehicles, both small animal and large animal, but this is a personal vehicle. Most of the time you tell us I bought a vehicle and there's nothing we didn't need to know unless it used to be a electric vehicle or you had some type of credit. Now going forward, depending on your income, you might be able to deduct your auto loan interest that you pay to finance that. So just keep that in mind. And then lastly, is this one's just water cooler talk. I've yet to meet a lot of veterinarians that will openly admit to being big gamblers. Maybe some of you are closet gamblers, I don't know, but at least for water cooler purposes, the new bill says that if you win a lot of money, you can only deduct 90% of that as losses, even if you lose more than you win. It's fascinating. We'll see what the lobbies in Nevada and New Jersey and all over have to say about that to see if it changes, but at least it's a fascinating tidbit from my perspective. Okay, so in summary, you buy a vehicle, you finance it, talk to your advisor to see if there's any benefit for the interest, and then, charity, get it through the business when you can. And at the very least, start keeping track of anything that you're personally starting in 2026, even if you take the standard deduction. All right, Nate, back to you.
Thanks, Andy. Moving forward to kind of a blended topic again, certainly having many business implications and will impact for those of you that have a practice and are going to have employees potentially with some of these questions. There was a few topics addressed with this, looking at tax on tips and overtime pay. This was something that was heavily campaigned upon and got some clarity on that. There's going to be some relief for these first few years. And that means that there's going to be some provisions related to the amount that is available based on income. And there's going to be some phase outs associated with that, Kind of a key item here too is that having a valid social security number is required. So certainly one more data point that will need to be reported as part of the return process. Deducting tip income. This was something that is going to be brand new to the tax code. And this bill allows for an annual deduction of up to $25,000 that would be reported on a W-2. This is going to be, however, though, limited to certain occupations. And that would be occupations where tipping is typically customary. So that would be things like hospitality, salons, those sorts of things. And additionally, there's going to be a deduction for overtime pay. Creates a provision for up to limited amounts for both single and joint filers, and looking at just the premium portion of overtime. So only the half portion of the time and a half, not 1.5 times wages for the deduction. And there's some definition things related to that that they've done a better job of clarifying once they kind of put this concept out into the sphere. Looking at how this is going to impact the reporting piece of this, which is certainly pertinent to businesses, the IRS has clarified they will not be updating withholding tables for 2025. That's a little bit unique because pretty much anytime there has been major tax law changes, they go back through, run through a number of scenarios of how this will affect most taxpayers, and they adjust those automatically calculated withholdings for payroll. They are not doing that. They're going to do this for 2026. So what we foresee potentially happening is for the employees that are really on top of their withholdings, depending upon what else they have going on, many people are going to have larger than expected refunds. However, I will say that the 2026 draft W-2s that have been released to a limited scale do show some additional reporting fields related to some of these items. So it might be time to, if you have not outsourced your payroll to a third-party platform, it might be time to really consider that because the reporting is only going to get more complex as part of this regulation. Looking a bit at some of the fringe benefits that are involved and run through payroll, bicycle commuting, permanently removed, moving expenses, permanently removed, dependent care assistance. This amount has been adjusted, but it's going to be adjusted for years after December 31st in general. A big one to highlight here, educational assistance programs. You know, in the past, there was a $5,250 up to $5,250 exclusion available for employee qualified expenses. The change was that it included direct payments to student loans. That was supposed to end at the end of 2025. That provision has been made permanent and adjusted for inflation going forward. So that is a key piece that could potentially be a game changer in terms of recruiting and providing tax-free benefits to your employees while also getting a deduction at the business level. Looking at some of the administrative sides of this, there was a bunch of updates related to Forms 1099 reporting, changing the thresholds, and looking at the numbers of transactions required for some of these forms. So just something to be aware of, generally increasing from $600 to $2,000. It's worthy to note that that $600 limit for paying contractors has pretty much been in place for several decades, and they're working to try and modernize it. So if we're getting a huge jump to $2,000, we'll see if that continues into the future, but at least they've raised it some for the time being. Lastly, regarding the employee retention credit, this was a hot topic for the last several years. But of course, famously, there were a number of fraudulent claims as a result of that credit and a number of providers that erroneously created deductions for a number of practices, and they call those promoters. The bill put in some provisions to allow increased enforcement for the IRS to go ahead and prosecute some of those promoters that may have taken advantage of taxpayers and put them in disadvantageous or even downright fraudulent positions. So overall, a nice provision that seems to make a lot of tax sense. Looking at some brand new tax advantage tools, one item that did gain some traction throughout the campaign process is this concept of Trump accounts. This is a brand new type of account. It basically operates in many ways like a traditional IRA account. However, the difference is on how it starts and then also how it operates once it's begun. Basically, you'll need to know that for children born between 2025 and 2028, there will be a $1,000 seed that will be available from the Department of the Treasury. And Parents can open those accounts on behalf of their dependents, or the Treasury will open it for them. However, they also realize that this is going to take some time to get up and running and administrate. So they've admitted that really these accounts probably won't even be available until July 2026. So for those of you with that children age in that range, it's just something to be aware of and continue to watch for updates on. The big advantage of having these Trump accounts is basically, as I mentioned, operates like an IRA account. The money in that account pretty much sits until age 18. And then after that, until 59 and a half, there'd be penalties on and taxes on those withdrawals, much like you would from an IRA. Big advantage, though, is that Trump accounts do not require earned income to contribute to. So something to keep in mind if you're thinking about ways to help your children build assets before they really enter the major workforce. Looking at a few modifications that are key, 529 plans got a huge revamp, allowing more additional expenses, and then also adjusting the annual withdrawals and a few other provisions. If these plans affect you or you've considered them for your children, basically this bill makes these a little bit more attractive as tools to use for your children's education and immediately starting their life after secondary school or even after high school. HSAs also got a bit of a bump that basically makes them a little bit more accessible with more qualified expenses, including direct care primary fees, telehealth, remote care, and of course some of this does involve around a deductible as well. But just know that these type of arrangements are becoming more and more common, and this legislation seems to recognize that. To bring this full circle, we do have ABLE accounts on here. There's certainly provisions in here on that. We're not going to spend any time on that today, but just know that those exist. But highlighting the 529 plan, or in the state of Wisconsin, it's called EdVest, and HSA expanded access and usage. Next, Andy's going to kick off some of the more pointed business provisions that will relate to practice owners specifically.
Thanks, Nate. So there's going to be a lot in here on depreciation, and I still get a lot of questions on what is depreciation. So just a quick depreciation 101 that then dovetails into these provisions. You buy a piece of equipment, you renovate, remodel your office, you put up a brand new building, etc. Depreciation is, how are we expensing that? How do I get a tax deduction for whatever I purchased or put in service? Okay, so that's the high level. What is depreciation? And depending on what you do, everything has a different useful life. 5 years, 7 year, 10 year, 39 year, 15 year, okay? And so basically when we talk about bonus depreciation or Section 179, we're going to talk about both of those. It's the ability to expense it sooner, quicker, to get the tax benefit right away. It's the time value of money concept. You get the deduction, you get more money in your pocket now as opposed to the deduction over time, okay? So what to know? Bonus is one way that you can accelerate the expense. Bonus was set to phase out and go away by 2027. It is now back, and 100% bonus depreciation is available. Another big concept is the qualified business income deduction. Some of you know it as QBI. Some of you know it as the 20% business income deduction. Again, that was going to go away. It is now permanent, okay? And there has been some expansion. So the point to take here is with your advisor, do I qualify for QBI? If I do, are we maximizing it? If I don't, is there any way to get into QBI and take some of the deduction? Okay, so those are the ones that were going to go away, but were extended, made permanent. What's new? 179 is the other way, in tandem with bonus, to accelerate expensing something, getting the tax deduction now. One caveat about bonus is Wisconsin does not follow bonus depreciation, okay? So if you take bonus, you're going to have a federal and a state difference in what you expense, okay? So a lot of times 179 can be more favorable if it's available. 179 can't create a loss in your practice. So just a couple little tidbits that are very informative. So for 179, just know, again, these are big ticket items. The limit was going to be over $1 million. It's almost been doubled. Okay, the expense limit now is 2.5, and the phase out went way up too. So just bottom line, if you buy something, okay, if you already bought something, be talking to your advisor. How are we expensing that? Are we taking the deduction in 2025? Are we factoring it into the future? You know, what's the plan? The other side of it is if you're still in the deciding point of are we going to buy something here and put it in service in 2025, does it make sense to do it before the end of the calendar year, or does it make sense to wait? Those are all discussions you should be having now. And again, an expansion, what's considered qualified real property? Same thing if, you know, we talked about purchasing equipment, but leasehold improvements. So many of you are expanding your facility or revamping your facility, adding a location, putting up a new building. So again, make sure you're talking about what qualifies and how we are going to expense that. Does a cost segregation make sense? Are we doing that to the best of our ability? We talked about how bonus depreciation was going to go away. It's back. It's been made permanent till future tax legislation changes it again. Everything has been expanded. So again, have the conversation on, are we doing bonus? Are we doing 179? And make sure that your advisor explains why and why it makes sense for your practice based on financial performance both this year and what you're anticipating in 2026 and beyond for the future plans of your practice. Okay, meals. We could have a separate conversation about, you know, cleaning up your books and having separate accounts. But what you may or may not realize is that some meals or some expenses that you have on food in your practice are considered 100% deductible. Most are considered 50%. Some are non-deductible at all. They're 0% if they're considered entertainment. But basically, what the law said is that whatever was 50% deductible, that should be in a separate account so that at tax time you know that it's only 50% deductible, that 50% deduction has been retained with some additional revamping and clarification. Okay, so really to summarize these three, I think both with 179 and bonus, if something's already been purchased, okay, have the conversation, how are we handling it? Okay. If you're on the decision point on the fence of buying it now or buying it in 2026 or beyond, again, have the conversation based on financial performance, future plans. When does it make the most sense to both put it in service, purchase it, and also how should we be expensing it / depreciating it? Okay. State and local tax, also some of you know it as SALT. Okay. So when the last big bill went through, as you might know, the limitation was set at $10,000 for state and local income tax deduction, okay, which especially those in high tax states or those who own multiple properties was a big hit in the pocketbook. So what a lot of states did is that, hey, instead of trying to deduct your state income taxes at the individual level, let's deduct them at the entity level through the business. So then you get a deduction on the federal side. And there were no challenges. 36 states plus New York City adopted it. So now the new bill said, though, hey, the SALT limitation, the state local income tax deduction went up to 40,000. So now there's a lot of talk. Well, I've been doing the pass-through entity tax. Does it still make sense for me at the $40,000 level? And what I'll tell you in short for today is overwhelmingly the answer is yes. Most of you practice owners, most of you based on the income level that you're at, the pass-through entity tax election deduction still makes sense. But be having that conversation. If this is the first time you've heard about it, you should definitely be talking to your advisor about it, but have the conversation on, does it still make sense for me and are we taking most advantage of it? And I think the caveat is here, what we're talking about is federal tax legislation, right? That was passed on July 4th. But guess what? It still needs to be interpreted. The regulations still need to be written and published by the IRS. It still needs to be put into the tax software, disseminated, the specific laws. So it's going to take time. And know that in tandem, all the states are going to take what was changed at the federal level and decide, are we implementing that? Are we going to conform or are we going to have different rules? So just know that as you are interpreting and working with your advisor on what changes at the federal level, you have to consider, depending what state you're in, does it apply at the state level as well? Okay, so takeaway here is the pass-through entity tax, I think, is still very valuable and beneficial to most of you, especially at the higher income levels, especially those of you that are business owners. Okay, so continue to have the conversation, making sure that either you're implementing it if you haven't before, or you're continuing it if it's something that's been in practice for a number of years now. All right, Nate, back to you.
Thanks, Andy. The final business related topics in here all relate to energy provisions, and we've got a number of data points on these slides. The key takeaway of these is timelines, 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 both on the residential side and the commercial side. For those of you that might also be facility owners, the key here is if you're planning on making any energy efficient improvements, there are various timelines and cutoffs with these. And in general, all of these energy provisions that have existed for the last several years are ending. It's just a matter of when. So if you have projects in place and started with contractors, the key here is going to be communicating with them so that you are meeting the appropriate deadlines and taking advantage of potential credits that you may have been planning on. This goes to residential, this goes to commercial real estate, this goes to extends all the way down to some of the vehicle credits that have existed, home improvements to match and be compatible with some of the vehicle charging requirements, commercially having charging stations available. All of those provisions are all set to terminate at various points in time. Some key ones are going to be namely already in 2025 or upcoming here within a few months in 2026. The key here is almost all of them are ending. It's just a matter of when, and some of them have definitely accelerated or already happened for whatever your timeline might be. A few remaining items to be considering is, again, thinking about adjusting your timelines with your contractors, but then also if you have investments related to some real estate property or real estate investing companies, know that there is still some credit transferability that does exist for those of you that may be invested in that direction. With that, I want to kick it back to Lee for wrap up and any questions.
You guys, that is so much information to cover in a very small amount of time. I know you guys have done a similar presentation in an hour, and we've had some other ones that have been a couple hours. We probably do a full day on this. A lot of information, you guys. That was 51 slides. Let's do this, knowing that we're coming up on time, and knowing that we just bombarded people with a lot of information. If you guys work with practice owners and people in this industry, if you had to boil this down to just kind of 2 or 3 main takeaways, what would you say are kind of those main either changes or things that people need to start paying attention to that maybe they haven't been before?
For me, I think some of the big items is some of the changes in depreciation that are available. Right now, it seems like a lot of folks with the contractor market being what it is, and things have somewhat normalized in that industry, and they're catching up. Seen a lot more building improvements, knowing what those energy credits are and how they impact those for the folks that might have been considering, for example, putting solar on their roof. That's a huge determinant in whether that cost makes sense, but then also thinking about how this is going to be depreciated, working with your contractor to get the best data you can so that if your advisor or whoever your advisor is, can work with you to try and maximize some of that cost and cash that went out the door and capture some of that tax benefit now.
I think for me, so many of the provisions have a phase out at a certain income level. Okay. And so to me, I think it's just knowing those phase outs, knowing your income level, knowing that if you're close to the phase out, how do we manage that? Does it make sense to take accelerated depreciation and bring our income way down? Or then are we losing out on some of that QBI deduction if we take it too far down? So it's really looking at all of them in aggregate, doing a tax planning in advance, proactively as opposed to reactively, and making sure that you're taking most advantage of what's in place.
Great. That's a great summary, and you guys, great information. Thanks again for sharing with everybody. As we wrap up, I just want to let everybody know you can go to sva.com/OBBA. So that's 3 Bs. To see additional information like biz tips, our past recorded webinars that are a little bit more general in nature, upcoming webinars. And then, as I mentioned earlier, we do a weekly podcast called The Biz Beat by SVA, where we're spending 15 to 20 minutes every week on different aspects of this bill and other issues that might be affecting you. So please subscribe on YouTube, Apple Podcasts, or on Spotify. Our next webinar, specifically for vets, is on November 18th, where we'll be unveiling the results of our 4th annual veterinary salary and benefit survey. So please sign up for that. And just a reminder, all the content here today was designed to just be a general overview of how this bill might affect you. But you and your business are unique. Your structure, your size, your industry, and lots of other factors are going to determine how this is going to affect you. So all that to say, now more than ever, you should have a very strong tax and business advisor to help you navigate what's best for you and your business. And guess what? That's where SVA comes in. So if you haven't been doing proactive tax planning, now is the time. So we're only a phone call away. If you're already a client, please reach out to your SVA professional. And if you're not a client, please reach out to me and we can talk about how to make you one. Thanks again for attending today and have a great rest of your afternoon. And we hope to see you on November 18th, where we unveil the results of our vet salary and benefit survey. Bye-bye.